Here I'm going to be talking about central banks as enablers. So just to give you an example, this part focuses on central banks, its key mandates. So this is a small subset of the bigger module. When we are looking at central banks, we want to look at some of the key functions. One of the most important function is to promote monetary and macro stability. A lot of banks have different mandates. It could be either dual, it could be or hierarchical. It's actually one you will be looking at. You could be looking at two options. So some of the mandates you could look at is price stability, maximum sustainable employment, growth, currency stabilization. We look at how different banks have their own agenda. The most important part is to promote a sustained and efficient financial system, implement rules and regulations which bring in stability to the financial world or the economic stability. And one of the key important is to have a smooth payment system, smooth running of the payment system, the economy. This particular aspect, today I'll be talking more on how they promote specifically the monetary policies. We're looking more towards the monetary policies as in this particular module. In this here, I've taken an example of Central Bank of New Zealand or the Fed. This is a part of a dual mandate. When we talk about central banks must be looking at stable prices, what are we talking about? It is either they can target price level or they could target a percentage change in the price level or inflation. Second is maximum sustainable employment. These two are known as the dual mandate. The banks only target inflation, and some of the central banks have different mandates. We'll also see Central Bank of China and how it's got a different mandate. In this case, when you're talking about dual, both of these mandates are important. Now, this is to give you an example. Now, when we talk about inflation, and this would keep coming in, we're talking about, so there are two types of inflation, and we'll discuss this in depth also with examples. This demand pull, where goods and services exceed the supply of goods and services. This is the demand pull side. The other could be push side. A lot of times it could be the input of goods and services. Price of the inputs of goods and services increases. Support of prices, it could be the capital flows or an exchange rate, especially for an economy like India. Exchange rate would be very vital. Some study done, and I'm going to share it at a later date. This just to give you a fair idea. We're talking about there are two types of factors which could influence inflation. When we are looking at monetary policy, we are again, just to put a macroeconomic policy, I'm talking about maximum sustainable employment, because in this series ahead, look at Phillips curve. But right now, if you look at it, the major part of the central bank is to set up interest rates, the short-term rates, and that is what they said, which effectively becomes the short-term rates or the lending rates, which becomes the benchmark of prime lending rates. The other is to moderate long-term rates. Now, this is very important. Understand when do the central banks try to moderate long-term rates? They do it by buying and selling of long-term bonds, usually buying of short-term bonds when we talk about asset purchases or quantitative easing. We are talking about monetary and fiscal policy. We are only going to be talking about monetary policy here. Fiscal policy is something talked about. When we are talking about policy, we have seen taxation. You can refer to the modules before. Today, when I'm going to be talking about, I'll be talking about open market operations, how the change in supply changes, and a bit more. Just to sort of give, all these policies are to sort of boost aggregate demand, which is what we need in the time of a recession or contraction. We want to boost the aggregate demand. We'll be just touching upon modern monetary theory with an example. This is just to will not be going deep into any aspect of these theories. Look at modern monetary theory. What it means is that deficits don't matter, and you can keep printing money as long as you can borrow money in your own currency, because you're printing. What it says, you can use printing press to sponsor budget deficit. Now, Mr. Powell, who's heading the Fed chair, and this is not what is by the middle road. This clear-cut analysis says that this is something which is not justified. These administrations have done it before. It's not sustainable. The US debt anyway is very high. As a percentage of the GDP is more than 100%. Debt at this point of time is about, the last figures which I have is around $28 trillion. Taken Jan 2000 and from 2020. Jan 2000 as the index, which is like if taken as 100. Now I want to see how much debt, public debt as a percentage of the GDP has increased over time. So in the last 2 decades, if you see, it has increased by 138%. This data, not the data of US debt as of March 1, the total US debt is about $28 trillion. That's from a different source. That's from the balance.com. Look at this graph. What it means is, like in Jan 2020, the debt was about 238% as a the public debt as a percentage of gross domestic product was 238%. But if you look at total debt, sort of look at the debt, about $28 trillion. Look at lending as a last resort. We'll be looking at what are the major tools central banks have. Central banks actually basically use three types for lending as a last resort. They use lending borrowing on the open market, and we look at the open market for repo, reverse repo. Purchase assets or quantitative easing in open market to expand reserves of central bank. This is distressed lending. So they can do during the times of financial crisis. We have seen great recession. When there is a systemic risk within the system, the central bank or the financial system can ask for distressed lending. So these are the three major tools when we're talking about as a lender of last resort. Central bank has many other tools for regulating liquidity within the system. I was talking about when we looked at the mandates, these are the central banks when they are only targeting inflation. That is their top agenda, and they could look at others also. So these are United Kingdom, Sweden is the oldest central bank in the world, Australia and ECB, European Central Bank. Whenever you're looking at dual mandates, I talked about sustainable development and inflation. So that's US and New Zealand. But if you're looking at the Bank of China, it looks at stability in the value of currency and to promote economic growth. India looks at price stability and economic growth. This price stability, predominantly, they are targeting inflation. So the question is, what are reserves and repo rates? So reserves are the cash which the bank's going to be holding either in vault or with the central. Would always be some amount of liquidity within the bank. Central banks can infuse reserves into the system through the repo market, which is what basically they use. For repurchase agreements that are short-term secured loans, wherein a party buys the securities from the other party at a specific time in the future, it's going to buy it back at a rate. Change in price is known as the repo rate. So if I'm going to sell and I'm going to buy back after some point in time, I'll always be buying it at a higher rate, and which is basically the interest rate on that particular the secured loans. This is a very good way of actually managing the liquidity and reserves in the system.